My name's Ray Thomson. They call me a veteran angel investor, and I was the chair of the Angel Association in New Zealand here before Marcel. So it's my pleasure today to introduce this session, which is about digging into angel deal flow. What sort of companies are the companies us angels should be investing in? So first of all, to get the proceedings underway, we've got Carolynn and John Levy from YCombinator. They're two of the founders or the partners of YCombinator, and their speciality in YCombinator is looking after a lot of the legals. But here we are.
So John and I are going to use notes because our usual crowd here is a big room of founders, not a big room of angels. So bear with us. So as Ray said, we're going to talk about the role that incubators and accelerators play in providing quality deal flow for angel investors, based on the assumption that the primary factor affecting deal flow is the incubator's selection process, and the secondary factor is the type of advice given and the environment created by the incubator during the program. We're going to talk about these factors from the perspective of what we do at YCombinator and how YC's approach may differ from other incubators and accelerators. We have a mantra at YC that reading applications and choosing the right companies are the most important things that we do. There are a lot of distractions at YC because we have a lot of projects going on, but we all agree that if we don't get the selection process right, if we don't pay extremely close attention to it and miss a great company, then we're failing. Our applications are pretty long and there are many things to consider when reviewing them. But there is one aspect that we weight more heavily than any other, and that is the founders.
YC's primary goal when selecting companies is to choose great founders. We will choose great founders even though they may seem to have a bad idea. Why do we emphasize founders, and what do we think makes a great founder? First, great founders can build. Anyone could have a great idea, but a great founder can take an idea and build something without needing an expert or team of people. Founders who can't build have to take a different path with their startup. They are less able to bootstrap and usually need money to make key hires to build out the business. Founders who can build are the key hires. At YC, this means that most of the time, we're looking for founders who are technical. We make exceptions, of course, but the bar for non-technical founders is much higher. Second, great founders have strong relationships with their co-founders. We look for founder teams that have authentic relationships and have known each other for a long time. One of the questions on our application is how long have the founders known each other? We do not believe in founder matching. It is a red flag for us when founders with no previous relationship have been artificially paired up, or when a founder has brought on a so-called bolt-on co-founder at the last minute. We look for co-founders who are actual friends. We always ask them how they met. The ideal co-founders have built something together in the past. They're college dorm mates who spent their freshman year building an app or a program to hack their final exams. Third, great founders are driven. This may be the biggest difference from what I heard last night, the desire and the drive in some of the founders that we focus on. When we are reviewing applications, we do look at founders' formal education, but we'd rather see a founder who's on a mission, a founder who is driven. We like dropouts because those founders typically aren't following the herd. They're on a mission to create their own path. Finally, great founders are not any of the following. These are red flags for us. 1, equity hogs. A great founder team distributes equity equally. A disparity in stock allocation indicates a team where not everyone is valued. Teams like this are often doomed because building a company is a long-term process, and equity hogs tend to take a short-term view. 2, an ill-suited team. This goes back to the point about founders who can build. In some founder teams, we can spot what we call cagers, where a business person has teamed up with a technical co-founder, and the business person makes the technical founder work in a metaphorical cage and do all the work of building the company. This is what we mean by ill-suited, and it's obvious that these kind of founders are not on the same page. If a startup has a team of 2 or 3 co-founders, there shouldn't be one whose only function is to hang his or her MBA on the wall and assume the title of CEO. Every founder in the team of a startup should be someone who can build. 3, resume builders. For some people, starting a startup is the trendy thing to do, and getting accepted by a prestigious accelerator is like getting into a prestigious university. They don't really want to work hard building a great company. They just want to have a resume that includes the name of prestigious accelerator. In our experience, these people will quit their startup the second things get hard, which is pretty much immediately. 4, single founders. Like many incubators, we worry about accepting companies with a single founder because startups are difficult. And bearing the burden of growing a company alone is stressful and demoralizing. We do not have a rule about accepting single founders, but these founders have to be special. Much like non-technical founders, the bar is higher for single founders. There are some other things we do at YC that we think improve the selection process, such as conducting in-person interviews. We fly people in from all over the world. We don't fund a company unless we've met the founders in person because we don't believe you can get a true sense of the character of the founders through an application video or a Skype interview. We also rely on our alumni network to give us intelligence about applicants. A lot of people who apply to YC have worked in Silicon Valley or elsewhere in tech, so we can take advantage of the connections between alumni and applicants. If we hear from an alum that a particular founder is super impressive, that's really helpful in our evaluation process.
Is there a correlation between quality deal flow and the maturity level of the companies graduating from incubators and accelerators? The answer is probably yes. Companies with traction, growth, revenue, and employees are going to feel less raw and risky to angel investors. But should incubators and accelerators be striving to appeal to and accept startups that are further along? On the one hand, I think yes. At YC, we get a lot of applications from mature companies. In fact, I think a myth has developed that we only accept companies with some traction. That's not true, but it has been the case that in recent years, we've accepted fewer what we call no-idea companies and fewer really, really early-stage startups. But YCombinator is 10 years old. We get approximately 5,000 to 6,000 applications for each one of our programs, so I don't think this trend is surprising. On the other hand, I don't believe that incubators and accelerators should aspire to fund only the most mature companies that apply. I think incubators and accelerators should aspire to fund great founders with innovative ideas. We just rolled out a new program called YCombinator Fellows that could be described as YCombinator getting back to our roots. The Fellows program only accepts companies that are at the idea stage with no investment, no MVP, no traction. As I mentioned earlier, a secondary factor that affects the quality of the deal flow is the quality of the incubator or accelerator program. The theory that I'm positing here is that regardless of whether an incubator has selected great or mediocre companies into its program, once the companies graduate, they should be better companies. And I'm not talking about better in the sense that they can give slick and polished presentations at demo day, but that they truly understand how to build a great company. There are something like 2,500 accelerators and incubators worldwide currently, maybe even more. The ones I know about all follow roughly the same format, the gist of which is to give startups advice, mentoring, exposure to press, and to investors. YCombinator follows this format too, but our approach may be different from other incubators and accelerators in the following ways. One way is that we aren't afraid of pivots. In some cases, we actively encourage them. If you are questioning how great founders can be more important than great ideas, this is one answer. Great founders will discover quickly if what they are building isn't working, but instead of quitting, they'll just pivot to a new idea. Founders who spent a lot of time building things and hacking are rarely out of ideas for what to build next. We had a company in our summer 2012 batch that came to YC working on a new kind of Wi-Fi router. And about 6 months after YC, the business wasn't growing, so the founders decided to make a powder food substitute that replaces eating 3 meals a day. It's called Soylent. Usually pivots are not so dramatic, but really smart, persistent founders will eventually hit on a great idea, whereas not so great founders are more likely to quit once they discover that their first idea is not working. Another way we might be different is our approach to founder breakups. The distinction here may be geographical because I think most US-based incubators deal with breakups more or less the same way. But we believe it's critical for founders to own restricted stock that is subject to time-based vesting. If a co-founder decides to leave a startup, the remaining founders can usually carry on before without any equity-related drama. The whole problem of founder breakups underscores the importance of John's point about founder teams having authentic relationships. I'll mention, though, we had one of our ugliest breakups in the history of YC where brothers, they imagine holidays at their house. So even the closest relationships can fail. Another important aspect of YC's program is the influence of our alumni network. It's like instead of having 20 or so mentors provided by the incubator, YC's founders have about 2,000 mentors who are very attuned to the challenges specifically faced by startups. Our alumni make introductions for each other, they troubleshoot with one another on technical problems, they share referrals and advice and a million other things. We think it's very important to foster an active and loyal alumni community because it adds to the quality of a program. Finally, at YCombinator, we teach founders to be resourceful rather than just providing founders with resources. We don't have any co-working space at YC, and our program doesn't really actually have that many perks. We take a very tough stance with founders about getting things done. If we sense a founder is talking instead of doing, we push them very hard. We try to adhere to the philosophy that it's better to teach people to solve their own problems than to solve their problems for them using our resources.
At the end of every YC program, we get 2 consistent pieces of feedback from the founders. The first thing they tell us is that they got more done in the 3 months at YC than in any other time of their lives. We take very impressive founders and put them in an environment that allows them to focus on their company. That's pretty much all we do. The second piece of feedback we get is that the founders value the alumni network more than any other part of the program. It is not surprising that exceptional founders recognize the value of connecting with other exceptional people. The better the founders and the better the program, the better chance angel investors.
What about husband and wife teams? And you are the guys to ask this to.
That's a whole other conference. We need to have days for that.
We've had a few.
We've actually had, husband and wife teams at YC. We've had at least 2 or 3.
So it's not a deal breaker, it's just something you set a higher bar for.
You understand the strengths and weaknesses, obviously. I'm sorry.
Probably wrong. Yeah, so we've had brothers break up, but so far no divorces.
But you do understand people's strengths and weaknesses. The point is understanding people's strengths and weaknesses. Husband and wife teams usually understand what the other person is very adept at and what the weaknesses are of the other person.
Okay. Hey, look, thanks very much. And it was great that you could come all the way from the States too.
We're so happy to be here. Thanks for inviting.
So this breakup of founder teams is an important item. They are going to address this more on the I think there's the session on term sheet, the speaking on that. It's become an important issue, particularly out of our Lightning Lab Accelerator. So I've asked them to get down and dirty on that one in that session. So the next speaker is David Hughes. He's a director of Kiwinet, and I've asked him to speak around the subject of Kiwinet interacting more with us angels.
Morning, everybody. The point I want to make is that I believe that the public research institutes in New Zealand are an important potential source of deal flow for the angel community. And I've got 3 reasons why. And I've only got about 5 minutes to do this. So here's reason 1. Firstly, I think the public research organisations in New Zealand are good at their core business. So a university's core business is knowledge creation and then distribution via teaching and publishing. And New Zealand universities are good at that. They're above average in the OECD on publication rates, coming in about 11th, that's just below the upper quartile. The public research institutes, the CRIs in New Zealand, they run a slightly different core business model. They create knowledge and they generally distribute it via contract research with industry players, often large industry players. Again, they're good at that. In fact, they're first in the OECD in terms of level of commercial funding into research institutes. Now, some of you may be asking yourself, okay, that's good about their core business, but what's that got to do with deal flow for angel investors? And that's a really good point, because their core business models are not set up to create deal flow for angel investors. Which brings me to my second point, and that's that New Zealand's been focusing for the last 10 years or so on creating mechanisms to create a third distribution channel, a distribution channel of knowledge, either to SMEs or to startups. And let me just run through some of the mechanisms that have been used, and I'd like to suggest that some of those mechanisms are starting to work. We're seeing positive signs of these really making a difference. The first of these is PSAF, that's Preset Accelerator Fund. It's a relatively modest amount of money made available to researchers to allow them to make their inventions investor ready. It's been running for about 10 years, and let me give you some quick statistics on it. Around 600 odd projects have run through the PSAF model, and about 400 of those have resulted in commercial deals at the end of the projects, which is a pretty high batting rate. We had a look at a small subset of that data and asked the question, okay, how many of those actually went to startups or spin-out companies? Of the ones we looked at, of projects that had successfully got to a commercial deal of some form, about a quarter of them resulted in a spin-out of some kind. So quite a high creation rate actually happening via those mechanisms. While talking about spin-outs too, if you went back 10 years, New Zealand University and Research Institute spin-out rates were around 2/3 of those in the US, so a relatively modest rate. 5 years ago, it had risen to parity with the US and Australia. No real recent data, but we'd hope that that trend was continuing. So a suggestion that PSAF as a mechanism is actually starting to work. Second thing I wanted to talk about was the CPN, or Commercialisation Partners Network. Now, Ray mentioned that earlier. That's a national network across the technology transfer offices in the universities and across the CRIs and other research institutes. 3 major components to it. There's Return on Science in Auckland, there's CRIS in Christchurch, and then there's Kiwinet, which is nationwide. The whole intent there is capacity building, peer-to-peer learning for people active in that space. Again, relatively new structure, so a bit hard to put metrics on it, but we believe it's starting to drive a difference in the way those organisations work together on raising professional standards in commercialisation in that space. The last major mechanism is incubators, Callaghan Innovation and accelerators. Other speakers are going to talk about that, so I'm not going to talk about that. I'm going to skip on to my last point. And that's it. As I said right at the beginning, the core business models for universities and CRIs don't actually drive volume down the channel, this particular channel here. In fact, it probably only represents 1 or 2% of their activity. Now, that may sound like bad news, but I actually think it's really good news, because it's not that hard to double volume in a channel that's only consuming 1 or 2% of your capacity. Much harder to double volume in a channel if it's carrying 30%, just about impossible if it's carrying 50% of your capacity. So there's a great potential to actually lift volume that goes down this particular distribution channel. And we've seen some really useful clues on what drives that. When we look back over the last few years, we've noticed a particular trend there. Whenever we see an increase in volume down that particular capacity, it all goes back to an individual. There's a passionate person, a wise person, an experienced person who's gone into these organisations and has engaged in a very positive way with researchers and has driven a marked step up in deal flow out of that organisation. So that for us is the secret. There is a secret silver bullet here that could drive substantial higher volumes, even a doubling, tripling or more down this particular channel. And we think it offers great potential for deal flow for angel investors.
So it was actually good to hear last night that Kiwinet's actually been taking a few of these sort of more very early stage seed projects to a couple of the angel networks. Graham Scown, are you here from Return on Science? Because you haven't been doing that up in Auckland. Okay. So the next speaker is Jamie Rhodes, who's come all the way here from Texas, and he's the he's the Mr. Organiser of everything angel in Texas. So he's going to tell us what they look for up in Texas.
Let me start by first telling you the scale of the deals that I see. So around Texas, Last year, we invested about $45 million in about 100 companies. So we see lots of deal flow from lots of sources. First thing I like to do is define what is a good deal, and it dovetails nicely with what we've heard so far. First is a smart entrepreneur, and so that's somebody who's coachable, that's somebody who's listening, that's somebody who's customer-driven instead of married to their technology. And as we heard from YCombinator, rather have an undergraduate that's driven than a graduate student that's a scientist at heart. The company, to be attractive, needs to be able to address a large market. We see lots of great ideas that are very small markets, and be able to reach them. And of course, if they have customer traction in that market, that's the most important thing for us judging whether the company is a good investment or not. And last, that it's a good business deal. This list could go on forever, by the way, but I want to talk about sources. But that is, it needs to have a clean cap table, and it needs to not be convertible notes stacked on convertible notes, which is something entrepreneurs seem to want to do these days. The best deals that we see are not from any organized source. So we have lots of incubators in Texas. We have 26 in Austin, Texas alone. And the incubators are very uneven in their quality. To me, I judge an incubator by the quality of the mentors. If there's great mentors, generally the deals will be well educated. That means they'll self-select, and a deal that's not a very good deal will fall out of the process, realizing they need to go find something else to build their business on. Many incubators, even in Austin, Texas, are real estate based or are private incubators, and thus they make their money if they have a big hit. And if they think they have a big hit, what they'll tend to do is take that company to the venture capitalists, who will actually give them a kickback in equity, rather than open up all the graduates of their incubator for angel investors to look at and evaluate and perhaps grab first before their venture capitalists. I love university-oriented startups, but I've got to tell you, our luck with them is not that great. They're so very, very early stage, often beyond what they appear, and that has to do with professors. They're not trying to be deceptive, but they see one reaction in a test tube and they think they've solved a problem. They don't understand how to create a product, how to get customer buy-in. So the very early stage things out of universities, the professors often are misleading in evaluating the technology. The universities often are just trying to cut a deal. Either they want to cut a deal with you because they get a brownie point for getting a company funded, or worse yet, they don't want to cut a deal with you because they'd rather spend all their time trying to license to Dow Chemical than doing 10 licenses to startups. So once again, what that adds up to is the best deals we see are simply smart entrepreneurs that walk in off the street, that are a product of our ecosystem in the state of Texas, where we have worked hard to have lots of mentors, lots of education for entrepreneurs, so that they know what a fundable company is and what a smart company is. And the reason I wanted to make that point to you is because that sounds to me like what New Zealand is up to, and I applaud you for that. If you have a robust ecosystem of startups and you have good funding and you let entrepreneurs know you're really writing checks, what happens is all the smart entrepreneurs out there that are daydreaming about starting companies realize they can really do it. And what they do is start working hard then to get educated on how do I build a fundable company and a good company. So the fact that you're having this conference, the fact you have so many angel groups that are doing so much investing is the way to ferret out the best entrepreneurs and to get them funded and for us angels to make the most money.
So our next speaker is Brett Holland. He's been involved with Lightning Lab, our New Zealand Accelerator, right from the beginning. They're doing a fantastic job in getting the companies to do fantastic pitches. They're doing a fantastic job about the mentoring they're putting around them. But what I'm finding as an investor, that some of the businesses look to me like a bit lightweight. Now Brett is involved in having a real hard, serious think about what the future of Lightning Lab looks like. And so I've asked him to share that with us.
Ray's exactly right. First of all, I'm going to take my 5 minutes and talk a little bit about Lightning Lab, what we are, talk about our evolution and some of the criticism that we've had and how it's evolved our thinking, and then what we're thinking of next, and put a challenge or a question out to you all. First off, in the land of technology, there's a web page here for you to give us your feedback. So part of that challenge at the end that I ask you, please do come back on our website on this and give us your feedback. Because we look at ourselves as we are New Zealand's accelerator. And what I mean by that is we don't have a fund. We're not like YCombinator. We're not like Techstars, even though we emulate them. We use public funding. Our fund is you guys, the angel community. You make us up. If we're not serving the angel community, we don't need to be around anymore. So let me tell you a little bit about how long we've been around. One, we started in 2013. We've run 3 programs, 2 in Wellington, 1 in Auckland. We're in the middle of 2 programs right now. One that's a digital program in Christchurch, and one that's focused on product companies, like we say, things you can drop on your toe. That's in Lower Hutt. We've worked so far with 28 different companies. 57% of them have received funding from the angel community afterwards. Of those, 88% are still going. We work, as I said, across New Zealand. We work with partners on that. Icehouse delivers our program up in Auckland. Wellington, it's Creative HQ. It's the Canterbury Development Corporation that delivers our program down in Christchurch. We focus on digital primarily, but we do have a program in product. And this coming year, we're going to actually have a program that's focused on female entrepreneurs, female founders, that we're calling Lightning Lab XX. That'll run in Wellington. So we're not YCombinator. I'm glad that John and Carolynn came out. Really a wealth of information, and we learn from them. We are part of a group called the Global Accelerator Network. We're very active in that group. As a matter of fact, I'm on the board of that group. It came out of the Techstars organization, and it's 88 of the top accelerators around the world. So we learn a lot from that group because it represents smaller markets like us. For instance, we're not YCombinator. We don't get 5,000 applicants per program. We get less than 200. So that sets us up with a different challenge, right? So let's talk about our evolution a little bit. Our first program we ran in Wellington, we really wanted to get focused on the most important thing an accelerator can do, and that is find product market fit and then market validation. So that market growth. That's the most important thing an accelerator can do for a company. We tell all of our companies, if you don't find that and you don't start getting the validation, you can't do anything else. And I know, because actually we did have one of our alumni go into the YCombinator program, got into it, and told us all about what the YCombinator program's like, and he said that's all they did, is focus on that product market fit. And yes, they did pivot in the program, but that's the best thing we can do. We did that in the first program. We pushed the companies out and said, you know, get a strong valuation, because after all, here in New Zealand, you have to start global from day one. Everybody talks about that. To do that, you've got to have a cap structure that allows you to do it. You've got to have room on your cap table to do it. Get a strong valuation. What was our criticism? Exactly what Ray said. You're not producing companies. They're too lightweight. The burden falls on the angel community. There's no support afterwards. You threw it out to us, and then you left us to take care of the mess, if you will. Right? And it's too high evaluations. We took all that in. We said, okay, let's work on bringing more mature companies in. Let's work on more programming. Let's make them more mature if they're younger. And let's push them to have lower valuations. Who do you think we got the criticism from the second round? The founders. They said, one, it's hard to find mature companies when you have a pool that's 200, right? It's New Zealand. Two, there's too much. They couldn't absorb it. They lost track of product market fit when we were trying to get them to fill all the checkboxes that are on the long DD list that all of us have as angel investors, right? They couldn't pack all that in. And three, with lower valuations, they really couldn't jump to the States. We had in our second program, 3 companies jump to the States. All 3 of them said our cap table was screwed up. So, what are we thinking of now? what fits for New Zealand? What fits for you all? What fits for the founders? And what fits for us service providers in New Zealand? We're looking now at taking and just focusing again on product market fit, but bringing out companies in 3 months that are probably more looking for things like convertible notes. I know I said it, I'm sorry, but that has to be something that we talk about. It's got to be part of the dialogue here. We can produce companies that have done the most important thing first, but aren't ready for valuation yet. And then focus the incubation stuff that's been going on post-acceleration. Fill the gaps, make it all work. Set another time frame, 3-6 months out, where they're ready for a value-based equity round. That's one of the things we're thinking about. The challenge then that I pose is that in line with the investment community? What would you think if you went to a demo day? And I know a lot of you guys have participated. I see a lot of faces that I've seen at demo days. I see a lot of faces that are mentors in our program. And that's a lot of what we do, is build the entrepreneurial community here in New Zealand, like Jamie was talking about. We have 250 mentors around New Zealand that actively participate. But what would it look like if you went to a demo day and you saw most of the teams looking for convertible notes? What would you think? What would the criticism be back to us then? I want to know before we do that, before we push that. So, like I said, please give us your feedback. We're here for you. Second, we do have 2 demo days coming up. One, this is also on your table. Christchurch is running a program, a digital program right now. There are 10 teams in the program. They're having a demo day on the 5th of November. We are here in the South Island. Please support the South Island. They're doing a fantastic job down there. Heavy economic growth, really grassroots initiative the team's doing down there that's running the program out of Canterbury Development Corporation. So I encourage you to go to the demo day there. And we'll have a demo day for our manufacturing program. That's our product-based program in Wellington on the 19th of November. So thank you very much, and I look forward to hearing from you guys the rest of the conference. Please do come to me, tell me your thoughts.
So I really would like to thank Brett for being so frank with us. I asked him to do that, put it all out there, because it's only by sharing his learnings that we can really help him and help the development of Lightning Lab in New Zealand. So the next speaker is Harveen Narula. He's just flown in this morning from Singapore. He's sort of heavily involved in the what you'd call the telecommunications sort of payments, digital SaaS sort of space, and he's just set up a major fund in Singapore. And like Harveen to talk to us about exactly what he looks for in an angel company in Singapore. Harveen.
Hello everyone. I have the privilege of leading a venture builder in Singapore called Hatcher, and I want to tell you about where our understanding has evolved to with respect to the kind of companies and teams we look for, because this is almost becoming a formula that we now use as a benchmark or a checklist to evaluate companies coming to us to look for either funding or mentorship. Hatcher is a B2B venture builder that is emerging markets focused. We are very open to taking companies that we find outside of Singapore, because to be honest, the pool of superstar companies or high potential companies in Singapore, while better than say 5 years ago, is still quite small. So we are very emerging markets focused, we're very B2B focused, and the reason for that is with B2B companies, their growth path tends to be a lot more predictable than for say B2C companies, where you have a gap in the market that's not being filled. You look for a team or a product that can fill that gap, and you work backwards and say, okay, how much funding do we need? What do we need to develop? What are the variables we can and cannot control? So we've chosen to stick with B2B. Our one B2C company is really a spin-off that came out of one of our B2B companies. We are very comfortable being minority shareholders, and typically we tend to have about 20% of the companies that we invest in after between 2 to 3 rounds. So To be able to do that, we need to make sure that our team selection is bang on the money almost every time. The areas that we look for companies in are fintech, media, services or SaaS, and security. And now I want to talk about the teams, right? So we tend to prefer teams, not single founders. We also have a very strong preference for older founders. Our sweet spot seems to be founders who are in the 38 to 45-year-old age band. And there's a simple reason for that. If you're doing B2B and you have to sell product to other businesses, especially big businesses with budgets, then it helps to look for people who have experience selling to other businesses. And it has been our experience that our companies tend not to fall over because people don't know how to distribute work, or don't know how to get along or work in teams, or just work really, really hard. And when you're taking people who've worked in bigger enterprises, who come to you and say, hey, I have an idea, I've spotted a gap in the market, typically at that point they've got kids in school, they've got a mortgage, they need to service a car. And so the stakes tend to be a lot higher for them. So a lot of them are serious from day one. And so that's worked well for us. So in terms of the team composition that we look for, again, we can't take credit for starting out with this set of criteria, but it's evolved over time and it's serving us well now. We tend to look for at least one person on the team that has very, very strong domain knowledge. So for example, in one of our fintech companies, one of the co-founders was this guy who was a superstar in investment banking, really knew his stuff, had run a big private equity house across the length and breadth of Africa for several years while still in his 20s. And he's in his mid-30s now. So we look for one really strong domain expert. The other person we look for on a team, on a balanced team, is one person that's really strong with technology and building stuff. And it's not usual for these two people to be the same person, right? So we don't insist too much on everybody being a technical founder. But it is very important in our experience to find teams where there are people who can build stuff. Because if you're talking about bringing efficiencies to product or to services, typically this involves some element of technology build-out. The third element that we look for in the team is someone who can really sell. And sometimes this is the same as the first guy. And then the last element which we end up providing is financial competence, compliance competence. And eventually, as the companies grow, they tend to take over that, and we teach them how to. So the lessons we've learned on the teams, and team selection really drives a lot of our company selection. Where we've done badly has been where we failed to move people out of roles that they were underperforming in. So it took us a while to develop the confidence to go into companies and to say, look, this is not working out. You're great, but you need to be in a different role. So we've learned, firstly, how to get better at team selection so that from the get-go we have people who are in the right roles for them. But we've also learned that sometimes you do need to make that change. Or sometimes the company pivots and one person, again, in one of our fintech companies, it started out as a financial services, an alternative lending company, and it's now pivoted to being a technology platform for fintech. And so the first guy, his role is less relevant, but his industry expertise is still needed. So we've moved him to chairman, and we've brought in a real superstar who's a good execution guy, and who knows, who's got a good handle on technology, good handle on finance. So where we've done well is being able to go in and shift people into the right chairs, which may not always be the chairs that are arrayed when your business starts. Where we've also done badly is in selecting founders who came to us with the wrong ideas of why they wanted to do this. So typically egotistical founders. So we killed one company and we're so happy we did that because it just wasn't going in the right direction. Not because the idea was bad, but because the team would not work together and were in it for the wrong reasons. The last lesson I want to share with you that has worked well for us is being very high touch with the companies that we work with. Now, typically, in our experience on our team at Hatcher, a lot of us have been venture investors or angel investors, and it is common to take a very light touch approach. So typically, you check in with your company once a month or once a quarter. Now, the companies that have done best for us have been companies where we are very high touch. So sometimes we're checking in with them 3 or 4 times a day, sometimes 3 or 4 times a week. And really it takes that level of involvement to build a strong business, especially in the B2B space. So these are some of the lessons that we've learned, and they are serving us well. Happy to have a chat with any of you all afterwards. But we're seeing the success rates for it.
So I often say to people, I often get asked, what does an angel investor look like? And I say they come in all different shapes and sizes. So here we have Harveen from Singapore. He's looking for older sort of founders. We've got Jayesh over here. He just told me this morning that for founders over 30, I'm sorry, they're getting too old. So there we are. Right, our final speaker is Willem van der Steen from Callaghan Innovation, and I've just asked him to just focus on exactly how Callaghan is finding the establishment of these incubators that were set up about a year ago. Willem.
Good morning, everybody. My microphone is on. I work for Callaghan Innovation, and I have the privilege to make 3 programs happening in New Zealand. It's the technology incubators, the founder incubators, and the accelerators. We believe it's starting to work. It's all coming together, but we need all 3 components to be really successful in the long term. You can't see one without another. We do believe that the latest additions of Accelerator, which Brad talked about, and I hear a noise, sorry, and the technology incubators have enriched the ecosystem. It's showing early signs of being more complete. We hope that this will result into more quality angel investment deal flow. I need your feedback to hear if it's really working or not. I hope that I stand next year here again and I can tell you it definitely works. I think it's important that we sometimes look back on what we have achieved. We have these 3 components working in New Zealand. It's getting better. We hear positive signs. We get more opportunities, more deals, and hopefully more high quality angel deal flow, successful buyouts, successful businesses, so that we shift our economy into the next gear. I really like to hear as well your feedback. Do you think we're missing something? Do you think we're doing the right stuff by supporting founder incubators, technology incubators, and accelerators? Or do you think we should be putting our money somewhere else? I think I will leave it at that.
Thanks very much, Willem. Callaghan was very much supportive of the science guys who presented first last night. So they, Kirsten Edgar, I assume Kirsten's here, but put a huge effort into leading that exercise. So thank you for that.